Hi everyone, welcome to BISP Solutions. My name is Abdullah Khan and today we are going to discuss about configurable consolidation, and the case that we are going to see today under configurable consolidation is regarding elimination of the unrealized profit from inventory which is earned through intercompany sales within the group structure. So for this I have prepared a particular case scenario whereby I have taken up two entities, one being a holding, which is C underscore 501. This is my holding company. And another being C underscore 502, which is the subsidiary company. And it is 100% subsidiary. That means the holding percentage is 100%. And we have prepared all the transactions that we are going to look into this case. We'll prepare a particular rule for elimination of the unrealized profit from the stock when the consolidated balance sheet is prepared. So the rule that we are going to prepare will run when the consolidation is done. So the rule is directly linked to the consolidation rule in our application, and the same will run once we run the rule of consolidation. So first we'll prepare the transactions through SmartView. We'll input the data through SmartView for the holding and subsidiary companies respectively, and then we'll create a rule. I have created a rule already for the for for this elimination of the unrealized profit from the stock. So we'll look into that rule and understand how the same has been created, and how we can create a particular rule for this type of a transaction. So the case that we have today, in this case, first we have taken a simple transaction of purchase of goods. So the entry that you're seeing at number 1 is a simple case of purchase of goods. So what is happening here is that C underscore 501, which is a holding company in my case, has purchased inventory of 15,000. So it will debit the asset that is inventory by 15,000 and credit the supplier or the creditor payable by 15,000. First, we have purchased the goods from an outside third party, purchase of goods from a third party, from an outsider, I can say. So this is my first transaction. Thereafter, this same amount of 15,000 of inventory that we purchased from an outsider has been sold within the group to C underscore 502. So this same 15,000 of inventory is sold for 20,000 to C underscore 502. So the entry that would be that should be rightly, the journal that should be rightly prepared is data, intercompany data. Since it's an intercompany transaction which will be eliminated at the consolidated level, we will debit the intercompany data instead of debiting the normal data. We'll debit the intercompany data by 20,000 since we have added a markup of 5,000 in this 15,000 of the inventory, and credit the revenue of 20,000 by the same amount. And the revenue account is also an intercompany account in our case, since it's an intercompany transaction. The third entry that has to be passed in the entity C underscore 501 is the reversal of inventory. So since the inventory has to be reversed from the books, since it's sold now to C underscore 502. So if we look at the financials of C underscore 501, the standalone financials of C underscore 501, so we should not see any inventory now in C underscore 501. The inventory should rightly be seen or should rightly be there under C underscore 502, which now has the inventory, and the inventory is gone from the books of C underscore 501. So it should be credited by 15,000, because earlier the inventory when purchased was debited by 15,000 and the whole of the inventory is sold. So it is now credited by 15,000. And the debit will then go to the intercompany cost of sales account. Since we are crediting the inventory and we have to debit an expense, because we will have earned a profit of 5,000, and how we have earned the profit of 5,000, we have sold the goods of which costed 15,000, we have sold them for 20,000. So what should happen is that a markup or a gain of 5,000 should be there under the financial statements or standalone financial statements of C underscore 501. So once all these three entries have been prepared, our balance sheet should ideally look like this. So under the asset side, for C underscore 501, we should have a zero balance for inventory, since we have uh, earlier debited when purchased the inventory and then we have credited when sold. So the inventory balance should ideally be nil. The intercompany debtor account under the standalone statements should be there, because this will get eliminated when we will run the consolidation. But in the standalone statements, it should be there. So the total of assets should come to 20,000. Then under the liabilities side, we should have a creditor of 15,000. This creditor, assuming we have not yet paid this amount to the outside or third party from which we have purchased these goods of 15,000. So it should come under creditor payable, assuming we have not paid the same to the third party. In case we would have paid the same to the third party, our cash account or the bank account should have reduced from the asset side. So the balance would have been 5,000 here and nil here in that case. So for simplicity, for running this case, we are assuming that the creditor is still persisting in the books by the amount of 15,000. Then we'll have a retained earning of 5,000. So how will this amount come is that we have a intercompany sales of 20,000 to C underscore 502, and we are debiting the cost of sales, because this item was purchased for 15,000. Now we have to book an expense since we are selling it, and the markup is 55,000. So the retained earnings account will have a balance of 5,000, and thus how our balance sheet will match with the balance of 20,000 on both the assets and liability side. Now, looking at the case of C underscore 502, the simple one entry would be passed here, assuming we have not yet sold this inventory further to any outside a third party. We have just purchased the inventory. So we'll pass the entry of inventory debiting by 20,000 and intercompany payable. Since we have to pay to our holding, we will credit the intercompany payable by 20,000. And no other entry has been passed here, because we are assuming that we have not sold this inventory further. And since we are not selling it any further, this inventory has an unrealized profit, we can say, of 5,000. So this 20,000 is having an unrealized profit of 5,000, since it's not sold yet. In case it would have been sold further, then the profit would have been realized by the sales of this inventory. But since this inventory of 20,000 has not yet been sold, so we can say that we have an unrealized profit of 5,000. However, this treatment would be given at the C level, at the consolidated level. And we have prepared the rule under configurable consolidation for this particular treatment or adjustment, we can say. So just a single entry is passed in the subsidiary, which is inventory debit to intercompany payable. So our balance sheet ties up 20,000 here as well. Then if we consolidate the financial statements of C underscore 501 and 502 after creation of a particular rule, and what do we say in that rule? We say that we are adjusting the markup which is earned when C underscore 501 has sold goods to C underscore 502 of say 5,000. We want to reverse this 5,000 since it's an unrealized profit. The inventory has not been sold any further by C underscore 502. So we have an unrealized profit of 5,000 within this stock, within this inventory. So we want to reverse it. And in order to reverse it, the entry that we have to create, so we can alternatively create it through consolidation journals as well, but we have given a particular rule for this under configurable consolidation. And what the rule does is, when we will click on consolidate under the rules, it will automatically debit the cost of sales by 5,000 and credit the inventory by 5,000. So the inventory then ideally the inventory should we consolidate all the assets and liabilities of our subsidiary. So ideally the inventory should have come at 20,000, since 100% of the assets and liabilities are consolidated. But what is happening now is that this inventory is having an unrealized profit of 5,000 since it's not sold any further. So this rule will eliminate 5,000 from inventory, and the inventory would be shown now at a net amount of 15,000. Correspondingly, the retained earnings figure, if we see the retained earnings of 5,000, which were there at the C underscore 501. So this will also get reduced by the cost of sales of 5,000. So the cost of sales of 5,000, it's a debit figure, so it will reduce the retained earnings instead of increasing it. In case it would have been a credit figure, it would have increased, but we have to debit the cost of sales since we are reversing the inventory, reversing the profit. So we have to reduce our profit by 5,000. So the retained earnings that we got at C underscore 501 were 5,000. We are going to reduce the same by 5,000 and eliminate the unrealized profit. So if you look carefully, you can see that this 5,000 was earned from this sale only, the intercompany sale, which should ideally be not there under the consolidated financial statements because this was a group sale, right? Since this was a group sale, so it should be eliminated, and the position of the consolidated financial statements would be the same that should ideally have been in case the transaction of intercompany sale and purchase would have not taken place. So if you look carefully, what has happened is that inventory is getting debited here by 15,000 and a creditor payable of 15,000 is there. So what is this amount? So if you see carefully, the amount that was there after passing the first entry, this is my first entry. So when I passed this entry, this was the first entry when I have purchased the goods from an outsider. Right. So since all the transactions after this entry, the second one, the third one in 501, the first transaction and the 502, all of these transactions have taken place within the group structure. So we want to eliminate the effects within the group structure, right? So if we want to eliminate the effects that have been taken due to the intercompany transactions, so mm, that means that we want to get into a position that was there before all these transactions have taken place. So what was the condition of balance sheet or the financials before all these transactions have taken place? We just had a debit of inventory of 15,000 that we have received, that we have got here as well under C underscore 500, and we had a creditor payable of 15,000, which we have now got under our consolidated financial statements by running this rule that we have created. So now we'll move to the application and see the creation of the rule. Or in my case, I have already created one rule. So we can just see how the particular rule was created and what inputs we have given there. So first we'll just go to the home page of our application. We'll go to consolidation. Under consolidation, we'll go to consolidation process, consolidated. Under consolidated, we have configurable consolidation. And if you can just close this tab. And when we select configurable consolidation, we can see here on the right hand side that the applicable consolidation members is elimination. So consolidation is one of our dimension, and the applicable consolidation member for configurable consolidation is elimination. So whatever we do here under configurable consolidation, whatever rule we run would be, the output would be shown under the elimination dimension of consolidation, under the elimination member of consolidation dimension. So let us just go through the rule that has been created by us. So here is the rule that we've created. The name of the rule is adjustment of unrealized profit. So this is the rule set actually. The topmost, the parent is called as rule set. So in case we want to create a rule set, we can go to this icon, the folder icon, and click on this. So we will be, we can create rule sets from here. And then this plus icon we have for creation of rule. So the rules that are within the rule set, uh, once the rule set is created, we can create further rules under this. So in a layman's language, we can understand that the first rule which is created under the rule set is for a particular debit or a credit in a journal, and the second rule which is created for the rule set again is for a particular debit or a credit for a journal entry. So this is nothing but an alternative to the journal, the consolidation journal that we can pass through our application. So in our case, inventory reduced with markup earned rule is the credit of our entry. If you can just see here, the credit is for inventory. So we are reducing the inventory with the markup. This is the credit rule. And the other one, the cost of sales, which is increased with the markup, is our debit rule. So likewise, in case we prepare some other rule where a debit or credit is a different account, so we can then prepare the rule for the same in this manner. So we'll just go through the rule set first, because some of the conditions that we give in the rule set cannot be changed when we are creating a particular rule under that rule set. So they get logged. Like first, I have just given a description. The name has already been defined. The description we can give here. So the description says that it eliminates the effect of the markup applied on inventories which are sold to intercompany partners. Intercompany inventories are reduced with the markup amount, and the intercompany cost of sales are increased with the markup value. Again, we can give the condition here. So in case we do not want to give any condition, we can ignore all the conditions, and we can, if we ignore any condition, all the conditions, then the rule will be set to always run. So the rule will run always, whatever condition we have given. So right now I have given an advanced condition, which you can have a look at it here. So my condition says that define the conditions to be met for rule logic to be applied. So we define the conditions, and the rule will apply to these conditions only. So if these conditions are not met, then the rule will not apply. So my condition says that the entity, the current entity, the current method entity, if it is equal to holding, so I can do this elimination when I am inputting the data in holding, or the entity current method equals subsidiary. So either my input entity is holding or the input entity is subsidiary, and the data value of the total input and adjusted. So this total input and adjusted is the top level member of the data source dimension. So you can just see it here. The data source dimensions top level member is total input and adjusted. So if my total input and adjusted value, the data source value there, does not equal 0, so that means it's either greater than 0 or less than 0, then this rule will run. So this rule will not run for equity companies, for proportionate or JV companies, but it will run for holding and a subsidiary company. So we can just cancel it. It's always already saved. Then we have a factor. So under factor, we have a lot of options. We'll see them. We'll go through them one by one. So right now we are just focusing on specific percentage. So what is this factor for? And then there is 100. So since I have selected the factor as a specific percentage and have given 100 as the value here, I can give any value here. I've given the value as 100 here. So what it does is that it means it is 100% elimination. So the formula of a factor is the source account, which is my markup account, which I've selected here. If you can see, my markup would be multiplied by the specific percentage, which I have given as 100. So in case my markup amount is 5,000, which was there in my case, in my use case, and we'll be seeing this through Smart View as well. So in case my markup amount is 5,000, that 5,000 would be multiplied by 100%, and the same amount will go through go to the elimination member under the consolidation dimension. So the formula says that the elimination member under the consolidation dimension equals to the account, the source account, into the specific percentage. We'll see this practically and then it can be understood better. Then we have a data set. So the data set also is the set of data which is applied to all the rules. So once we set the data under this rule set, we cannot change it when we are creating different rules under the rule set. So here I have selected the data set as current scenario. Whatever scenario we'll input the data on, the rule will run. The current year, whatever year we select while inputting the data to run the rule will run. Then we have selected likewise the current period, entity total. So I want my rule to run when I am consolidating my data. So the consolidation, as you know, for a 100% subsidiary, or in any case when a company is having a control over any other company, that is 51% or more, the consolidation dimension to be selected is entity total. So I have selected the entity total dimension here. The parent currency shows the data at consolidated level. So I have selected parent currency. Then periodic is the view which I want for my data to have. So I have selected periodic here. Then the accounts that I want, we can add the members, add different dimensions from here. So if I click on add, I can add these dimensions as well. But since I have already defined all these dimensions here, I don't want to again add these dimensions here. And this will mean that I can run the data on all the dimensions, all these dimensions, all the members of these dimensions as well. But specifically, I have selected some of the dimensions and their respective members, some of them being account, intercompany movement, data source, and multicap. So the account that I want to input the data is a markup account. So if you just go to the dimensions part of the application and see this account, the markup account that is created here, you just search the same. So here is a markup account which is created under the parent intercompany profit stock. This does not form part of our balance sheet hierarchy. Our balance sheet hierarchy does not comprise of this markup account. The properties, we can see it has similar properties to an account, but it is a saved assumption account. It is nothing, not an expense, revenue, asset, liability, or equity. It is a saved assumption account. So, and the console type is also ignored. Attribute values, nothing specific has been defined here, but what I want you to understand is that it will not roll up our values to the balance sheet since it does not form of part of any assets or a liabilities. It is just an input account. We will be inputting the figure of 5,000 under markup and we'll simply get the eliminations that we require under the cost of goods sold and the inventory account. So we'll select our source as markup account, which does not form part of the balance sheet hierarchy. It is a separate account. The intercompany, under intercompany, I have selected all the level 0 descendants of the intercompany. Since we are doing an intercompany transaction, we'll have to set the entities and as intercompany at the time of creation of the entities, and set the particular accounts as well as intercompany accounts. So I have selected the intercompany members, all the level 0 descendants of the intercompany entities. Then movement, for the sake of working, we are just taking the movement as no movement, data sources, data input. Then multi-gap I have selected as local gap. So these transactions will work on local gap. Now going through the rules, the first rule that I have created is for inventory to be reduced with the markup earned. So all these are logged here. All the conditions, data set, factor, all of them have been logged up here. The reason being, we once have to define these data set and conditions under the rule set, and then all the rules will carry over these characteristics from the rule set. The only new addition here is the processing option. So the processing option here means that what you want to do with this markup. we'll multiply the markup with the specific percentage, which is 100 in our case. So in case we take the markup as 5,000, input the markup as 5,000, that 5,000 will be multiplied by 100%, which comes to 5,000. And then what we want is to add or subtract. So the add or subtract rules of processing option works in a way, in such a way that if a particular account has the characteristics which are similar of the other account. So since the intercompany account is an asset account, okay, the markup account is a saved assumption account. So it is a negative account. It works like a liability account. So in case we have a liability account here and an asset account here, so what it does is that we have to give the option here as add, although we want to subtract the markup amount from the intercompany inventory account. But since the saved assumption is taking the characteristics of a liability account, a negative account, so for asset to be subtracted, for the markup to be subtracted from an asset account, we'll have to give the processing option as add. And in case of cost of goods sold, which we will see in the second rule, we have to give the subtract as our processing option, since it works in the direct correlation there. Okay. The intercompany, if we want to, so we'll look at the source. So this is our source account. Source account is our markup account, and the account where we want to do all the adjustments is the intercompany inventory account. Then there is an intercompany dimension which we selected under the rule set. We want the same to function, our target to be the same. This is target redirection. We want our target data to be under the same intercompanies. So we'll just ignore it, and the data would run through the same as the source dimension. For no movement, so in case we input the markup at no movement, we'll be able to see the intercompany inventory under the member of changes in net assets, since the movement for the inventory is the changes in inventory's net assets. The data source, the data input was the data source at the time of creating the rule set. Now I want this data source to be intercompany eliminations at my target. So I can just define intercompany eliminations here. Local gap, I want the same as source in my case. So this way we'll be able to eliminate the markup amount of 5,000 from our or we can say inventory. This account is not an intercompany account. The name is IC, although its characteristics, if you see, I'll just run through the properties of the account. If we IC inventory. So this ICO inventory is not an intercompany account. It's just for the sake of understanding that inventory that is there at the balance sheet date in the books of subsidiary is from the intercompany transaction. That's why the name ICO has been given, although this is not having the attributes of intercompany account. So just wanted to clarify this. Then we'll see the next rule, which is the cost of sales increased with markup rule. So what happens is that all the data sets and conditions which were defined under the rule sets are same here. The only difference here is that we have given the processing option as subtract, because these processing options run in a negative correlation. It's not direct correlation. So the account here is again markup account, which was selected at the time of creation of rule set. The target account this time is the cost of goods sold. So I want my adjustment this time to be made under the cost of goods sold account. The intercompany is same as source again. The movement that I want for cost of goods sold is the changes in net income. Data input is same as intercompany eliminations again. And the multi-gap again is same as the local gap. So once these rules are created, we can simply select them and click on deploy. So since these rules are already deployed, since this rule set is already deployed, I do not need to deploy it again. But in case this type of icon, the blue icon is showing there, so which it means that these rules are still undeployed. So if we check them and click on deploy, the particular rule or the rule set gets deployed. Once a rule set gets deployed, all the inherent rules under that rule set will get deployed automatically. So since this rule is already deployed, I'll just run the rule of consolidation from the application. I'll go back to rules and run the consolidation. We can check the result. But first, we'll go to Smart View. So here I have created the Smart View scenario, the exact scenario that we have created the example under the use case. So if you look closely here in the sheet 1, we have the input, and in the sheet 2 we'll see the consolidated figures. So for this, the first column, if you see, I have taken the entity C501 and I have created all the intercompany transactions that we created in our use case. The other dimensions can be seen here as well. So uh, ignore this markup account for now. We'll come to it later. The first account that we created in our use case was the intercompany, uh, or we can just go through from the beginning. So the first account that we created was the inventory and the respective creditor account. So the first entry was this, and the inventory gets eliminated. So we are not taking the inventory for 501, we are just taking the creditor payable. So the creditor payable is not an intercompany transaction, it is an outside party transaction. So I have selected, or I have input the figure at no intercompany, if you can see here. In column F, we have taken short-term payables as 15,000. So this is our creditor for 501, and this will remain intact till the end. The other entry, the second entry, was the intercompany sale entry. So the intercompany sale entry has to have the intercompany dimension for C502 ICP. So here we have taken 20,000 as IC revenue, which was our revenue in the case. We have taken debtors, that is IC receivable, which was there in our use case as well. The third entry that we had was IC cost of sales, credit inventory. So IC cost of sales, our cost of sales were 15,000. Our net income will come to 5,000 in this case. And the other effect was inventory. So the inventory gets nullified. So we won't show any inventory in C underscore 501. All the inventory of 20,000 will be shown under C502. The next entry was for C502, which was an inventory debit to IC payable entry, which we can see here. The IC inventory is there for subsidiary 502. This is not an intercompany inventory or intercompany account. It's a normal account, just for the sake of understanding that this inventory has come from through the intercompany purchases. So we have given the name as IC inventory. So this is an no intercompany transaction. So we have taken the IC inventory as 20,000, and the IC payable of 20,000 will be taken under 501 ICP member. So with this, we have completed all the inventory entries, all the journals of 501 and 502. Then we have this final elimination, or we can say adjustment entry, which needs to be passed at C500. So for this, we could have passed a journal as well, but we are not passing any journal. We have given a particular rule where we'll be eliminating markup from inventory and increasing the markup on cost of sales, increasing the cost of sales by 5,000. So for that, we just need to input one figure under the markup account, which we saw under the application, which is not an account under the balance sheet hierarchy. It is a separate account which is created under the parent intercompany stock. So we'll just input the amount of 5,000. Since this 5,000 has been earned by 501 by entering into intercompany transaction with 502, we can just create or we can just input a simple 5,000 here under 501 by selecting the dimension of intercompany as C502 ICP. And then when we will consolidate, we can see the results. It will eliminate the 5,000 from this inventory of subsidiary, and it will increase the 5,000 under cost of goods sold. So our net result when consolidation is run should ideally be seen like this. So we should have an inventory of 15,000, which was the inventory of subsidiary, which it has not yet sold to any outsider. So that's why the rule says that all the assets and liabilities of the subsidiary should be consolidated. So it will be consolidated, but it will eliminate the unrealized profit of 5,000 that has not yet been realized by selling the inventory to a third party. So since it was an intercompany profit, it has to be eliminated, which when we will run the rule will get eliminated. And we'll the retained earnings of 5,000, the net income, which we can see here under C501, will also get eliminated by increasing the cost of sales through the rule. And the only thing that will come under the cost of under the consolidated financial statements will be the creditor payable, which is the short-term payable in our case of 15,000. So the only two amounts that should be seen under the consolidated statements should be 15,000 of short-term payables and 20 minus 15 minus 5 of markup. So let me just run the rule of consolidation and then we'll see the results. So I'll go to rules. And run the consolidation for C underscore 500. The scenario is actual, period is Jan, year is FY15. We'll just launch the consolidation. Come back to our sheet 2 where I have created all the inputs. And this is our result after consolidation. So we'll look at it through the elimination dimension of consolidation, elimination member of consolidation. So entity total, this is my final result of consolidation. My total assets are 15,000, which is a result of the asset being 15,000 of inventory, which gets adjusted. It was 20,000 here when the data was input, but now it is 15,000 because 5,000 has been eliminated from the IC inventory. So if we check this under elimination of consolidation or intercompany eliminations as well of data source, we can see the elimination of 5,000 has been done from 20,000. So the net result, we can say net inventory, which is the correct inventory since it contained the unrealized profit of 5,000. So now the right amount of inventory is showing under the balance sheet, which ideally, in case no intercompany transactions would have taken place, had been shown in the same way. All the intercompany eliminations transactions get eliminated here, and the net effect is 15,000 is shown under the net inventory, and short-term payables, I'll just select the short-term payables, and then we can see that only short-term payables will be the account which will be having an amount here. So there is 15,000 under short-term payables and 15,000 under the net inventory, which rolls up to the total of the assets. So the total of the assets is 15,000, total of the liabilities and equity is 15,000. And the eliminations, if we see the 5,000 we have already seen, the intercompany revenue of 20,000 gets eliminated since it was an intercompany account. The IC revenue is an intercompany account, so it gets eliminated. It does not get rolled up. The IC cost of sales is also an intercompany account, so it also gets eliminated and does not rolls up to the entity total or the consolidated financial statements. The cost of goods sold is increased by 5,000. The rule that we set up was to increase the cost of goods sold, by the markup account. But what it does is that since it has increased the cost of goods sold, there is a markup there, the retained earnings of the C underscore 501, which has come through a plug account. So this is our plug account. So if we see, this is the difference of IC revenue and IC cost of sales. So in case you are aware of the plug account, the difference, if any, of IC revenue and IC cost of sales we have defined the intercompany revenue cost difference account as a plug account for both of these accounts. So in case there is any difference between these two, the same will go to the intercompany revenue cost difference account. So this is, we can say, a type of markup which was earned. So 20 minus 15, 5 is the profit. This is the profit markup which was earned. And this markup will get adjusted with the cost of goods sold, since it's an expense and this markup is an income. So this will get adjusted, and the net income, if you can see, is coming up to zero. It's rolling up to zero. And how it is rolling up to zero, if we just open it, we'll be able to see the continuing operations income. See, the cost of sales is 5,000, and the intercompany revenue cost difference, which is a type of markup, a plug account, both of them gets eliminated, and the final figure, which is getting rolled up to the gross profit and then consequently to the net income, is zero. So the only two figures that are rolling up to the total of the assets and the total of the liabilities are the net inventory figure and the short-term payables figure, like in our use case scenario. So this was an example of elimination of the unrealized profit from the stock, whereby the exact same position which was before any intercompany transaction can be achieved through this rule. So that's all for today. In case you have any queries, you can connect with us. Thanks and have a great day ahead.